Welcome back to Stock Brock. Today we're going to be breaking down what the headlines of a government shutdown actually means. Here's the question. If a shutdown is bad for the economy, why isn't the stock market tanking right now? It's actually still going up. Today we're going to be breaking down the real risk of the government shutdown, what history does tell us about these government shutdowns, why Wall Street does seem to remain calm, and how it could shake things up in the short term. Let's dive right in. Alright, to break down what a shutdown actually means, a government shutdown happens when Congress doesn't get funding bills passed before the deadline. That means federal agencies start closing, workers get furloughed, and spending temporarily shuts down. But here's the catch. Essential services like military, social security, air traffic control all stay online because that's mandatory. So while it does sound like a massive crisis, the shutdown mostly impacts short-term government operations, not the entire economy. In other words, Wall Street knows the government always reopens. The question isn't if, it's how long it will take. Now the next question is, why aren't stocks dropping? Historically speaking, the stock market barely reacts to these type of events. During the 2018 and 2019 shutdown, which was the longest in US history, the S&P 500 was actually up about 10% in 2 weeks after it ended. Why? Because the stock market doesn't trade on politics. It trades on earnings, interest rates, and liquidity. Investors tend to see the shutdowns as political theater, short-term noise that doesn't affect corporate profits long-term. Plus, the Fed's interest rate direction, inflation data, consumer spending have a much larger impact on stock prices than a few weeks of furlough. Here's some of the hidden short-term risks. Now that doesn't mean we're technically in the clear. There are short-term risks that traders should be watching closely. Number one is data blackouts. When the government shuts down, agencies like the Bureau of Labor and Statistics and the Census Bureau stop releasing key economic data like job reports, which are essential right now, CPI, which is essential right now, and retail sales, which is pretty essential right now as well. That means the Fed and investors lose critical visibility into the economy. Second is consumer confidence can take a dip or a massive dip. People see the headlines, worry about missed paychecks, and pull back on spending, especially if people are going to be out of work. And third, if a shutdown drags out too long, you could see delayed government contracts and defense spending, which can hurt industrial names and small cap stocks. So as an investor, what should you do right now? Number one is don't overreact. The market has priced in political dysfunction. Historically, every shutdown ends the same way, with a funding deal and a short-term rebound. Number two, watch the volatility, the VIX. If volatility spikes, that's when short-term trading opportunities appear. A temporary pullback could be your chance to average down on strong companies you own. And number three, Fed catalysts. Remember, inflation data and interest rate cuts will have 10 times more influence on stock performance than Washington drama. Alright, to close this out, so while the headlines might seem scary, government shutdowns are mostly a short-term noise and not a long-term crash trigger. The market cares about earnings and the economy, not Congress playing chicken with each other. Remember to stay strategic, stay informed, don't trade off emotion, trade off data and facts. If you found this breakdown helpful, hit the like button for the YouTube algorithm. Thanks for watching. Stock Brock. Peace.